What is going on, ladies and gentlemen? You thought we weren't going to be live? Man, we're live. We're live for a shorter period of time than usual today. I did want to clickbait you guys with the video we put out. Good old Alex in the thumbnail. Take a look at that if you guys have not already. But nonetheless, tomorrow's going to be a very important day in there, and I think there's a lot we need to talk about. So let's get straight into it, and let's hit you guys with a little bit of good old monetization. Even though you don't make any money off of live streams, it's good to have on because YouTube will promote monetized videos more than unmonetized videos. So let's get into it, baby. I hope you guys had a great day. I hope you guys are having a great night. And I hope you guys are ready to play. You guys came to play tonight. Yup. We're in there, baby. We're in there, baby. Let's go. Futures down just a little bit. S&P down 0.29. The Dow is down 0.22. And the NASDAQ down 0.35. Oil is up about 0.1%, and bond yields are up slightly. Nothing too crazy, but bond yields still sitting at 3.10. Tomorrow could be very important and likely will be very important for one big reason. And obviously, like I said in the last video, if you guys have not seen it, definitely go ahead and check it out. This one right here, massive warning, watch this before tomorrow. You guys definitely want to watch that. Basically gave you the rundown, but if you have not watched that video yet, the biggest thing for tomorrow, and potentially that could bring us a lot of pain, we'll go ahead and click out of that, is going to be the PCE data, and that is the main thing that the Fed likes to look at. Month over month is going to be important, but I do think we just need to see, the expectations come through and come in line, which PC price index year over year expected to come in at about 6.3%, 0.2% month over month. So that will be, a still positive month over month reading, but it would be down from the peak, pretty much the last two readings if we go down. But if this thing comes in higher than 6.6%, you're gonna have a lot of pain in the markets. And kind of why I say that is because where the bond yields are at right now. So the bond yields have came down from where they were at the peak, essentially at about 3.48%, and they've come down because people are fearing a recession. If we possibly, this is a possible scenario, it's not a guarantee, but a possible scenario is personal income comes in okay, personal spending comes in okay, PCE, inflation data comes in bad, you could see the bond yields tick up in a big way as the markets really stop freaking out as much about a recession and start to focus more on the Fed and interest rates, driving up bond yields, driving up mortgage rates, driving up all lines of credit in all different forms. So I think that is gonna be very, very important nonetheless. We got this whack ass thumb. Let me see. No, it says we got the right thumbnail. Okay, I don't know. But how are we doing, Me Too? Are we doing good? Are we doing good, brother? Look at that. AMC still eked out a gain even in after hours. Pretty damn impressive, if I do say so myself. And if we look at the main headlines on CNBC, China continues to snap up Russian coal at steep discounts. Charts suggest the recent boom in commodities is not long for the world, Jim Cramer says. Yikes. Jim Cramer, always with something. Lots of bad news on crypto too. But yeah, how are we doing? How are we doing? Says nobody wants to come play today. That's it. That's it. Y'all are like, I'll just go watch The Girlfriend. So I'm good, man. I'm good. You got me with the warning and all of that. Just I'm just gonna watch The Girlfriend. So if you guys have not seen her, go check her out. She's an official YouTube star as of recently. So yeah, some new things happening. But futures, Nasdaq down 0.25%. S&P down 0.22 and the Dow down 0.16%. Vlog, welcome to the live stream, baby. I know it's so quiet in here. I think they're all looking at, the Girlfriend, and it's all right. I don't blame them. I don't blame them. That thumbnail looks a lot better than that one. Just being honest here. Isn't bad news on crypto good for the squeeze? Potentially, yeah. It's good for, really drying up that liquidity even more. The thing with crypto is we just don't know how bad it is. We don't know if everyone's on the verge of collapse. That's what we could be looking at. People might have looked at crypto like it's so safe that we're just going to leverage down, right? You had Kathy Woods. You had very important people, quotes, for the markets talking about Bitcoin 100,000 by the end of the year. It's possible that a lot of hedge funds are in some serious pain, or it's possible it's only a couple large ones. Either way, I think there is a problem there, and I do think it helps when it comes down to it, yes, to dry up liquidity. So yeah, I would say in a nutshell, yeah, she's got a great mentor. There we go, baby. There we go. Thank you, Vlog. There we go. The hedgies are done. No, like quite literally. Yeah, like, I mean, if there's very little hedge funds that are positive on the year. The hedge funds that are positive, from what I have seen, have been in like oil stocks and some specific healthcare stocks. But yeah, for the most part, hedge funds are not looking so good. Like Tiger Global down 52%. Like, how does that even happen? You pay a hedge fund to hedge, not to lose 52%. So I think that's happening pretty much across the board. Not that many hedge funds are going to be inclined to say, hey, we're down 50%. But eventually, I think we're going to start hearing a lot more about hedge funds that are, beaten into the ground. Did you see the video? We love you, TC. Oh, we love you, Vlog. Always coming to play. Showing love. Did you see the video the CEO of HYMC dropped today? Very interesting stuff there. I did not see that. I did not. What's the deal with loaning out shares? Good thing or bad thing? Well, what it looks like right now, specifically with AMC, is very, like, I want to call it interesting. It's bullish. If we look at the shorts, and Ortex just added this feature, which I like it a lot, because you can see, what kind of amount of shares are available. We'll be able to see if there's like millions of shares that randomly pop up. But if you or anyone else has been watching the videos for a while, and we can even go back and see what these rates were yesterday, over the last couple of days, look at these rates: 13.71%, 14%, and there was only, sometimes 4,000, 8,000, 10,000 shares available, 3,000, 4,000, 25,000, and they were only charging 14%. Well, it went to 24%, and there was more shares available. And then you start to get, it was bouncing in between like 24 and 17% right here. And then you start to get more shares available, 200,000 shares, 150,000 shares, and they're charging almost 25%. That's kind of showing you that we could see a bigger move than not here in the short-term future. And the fact that AMC was positive 2% is, just mind-blowing, given kind of the pessimism, the red we've seen in the markets today, specifically with the Russell 2000. Look at that. I mean, the S&P hardly red, NASDAQ hardly red, but the Russell down 1.12%. That's wild to me. That is absolutely wild to me. But I don't think it's directly like a good or bad thing that they're doing it, but I think it is definitely showing us kind of what's going on under the surface, what expectations are. When somebody lends out stock to be sold short, you wouldn't do that unless you expected a bigger move than not, right? Because if you lend out your stock, think about it. You lend out your stock. Somebody goes ahead and sells your stock short. Well, let's say you owned 100 shares at $20, and they go out and, sell your stock short, right? And you agree to that. Well, if the stock falls to $15, you lost technically 25% as well, because when they buy back those shares, you're going to get your shares back at $15. Well, if you thought the stock could move up or down 5% or potentially more, then you're going to charge more. And that's to account for, potential upside or downside risk that is associated with that. So I do think that part of it is very, very bullish. Vlog, don't lend your shares. Where is Evergreens? Evergreen says, sheesh, you got a baddie. How'd you pull that one? Said, man, you calling me ugly, Evergreens? Huh? Evergreens was sending shots. I like it. Where you at, Evergreens? She was a champ, though. I'm like, yo, you want to do the intro? She's like, what do you want me to say? I'm like, just say, well, welcome back to the channel. Welcome back to the worst stock market in 50 years. And she did it. Only on like the second try. She's a champ. It's not potential. They are cashing in for liquidity to live another day. What about 3 arrows? Yeah, that's basically the highlighting the issue that is under the surface, because you don't really that's the thing with crypto. Bull markets are great when liquidity and capital is cheap, but when you're put into a market environment in which we are in right now, where expectations for interest rates, how expensive like a mortgage loan is, or a revolving line of credit, this higher interest rate regime, we've never had risky assets, and I put that in quotations, like risky assets like crypto, that have been put to the test in like 15 to 20 years. It's been a long time, and it's wild too. I got quoted. Guess what I got quoted for a mortgage rate today? Not a rental property. Rental properties tend to have higher interest rates because they're seen as riskier. Guess what I got quoted as an interest rate for a 30-year fixed mortgage with, over 760 credit score. Like, there's no difference between a 760 and an 850. So the best credit score you can have. I think they're just playing me. I'm definitely going to have to shop this one around. But guess. Take a wild guess. I was tripping, dude. 6? Yeah, that's pretty close. That's pretty close. It was actually 6.32. I'm like, what? Or 6. Yeah, it was like 6.32. In between that and 6.4, it was in the 6.3s. Wild. Wild, dude. This house I got right now, I got this in March of 2021. I had a 3.25% interest rate. Give me a break, man. That's almost double. He said 8%. Oh my gosh. Which, the wildest thing about all of this is, like, 6% is still not bad relative to history. But mortgage, housing prices, that's where it's, not so cool. But you know what you do about that? You go in, you say, hey, I don't know if you keep up with the markets, but you're probably not getting as many offers on this house now because people are getting scared of the real estate market. It's about to come down. Lay out a couple facts for them. Tell them about the Federal Reserve raising interest rates. They're getting shit up to 4 or 5% by, 2022 or 2023. By the end of 2022, at least 3.5%. That's where they want interest rates to be. It'll probably be a little bit higher than that. Tell them, at that pace, you're going to have mortgage rates of like 7-8%. People can't afford these houses, so, paint's messed up. I got to redo the carpets. I got to redo, the fixtures. I'm going to need like 25% off this house. If you want to sell it, I got the money right now. We can close in 2 weeks. It says Mafia's charging 20%. Psh, okay, I like 6%. I like 6% in that case. Said 20%. It's actually wild. What's up, bro? Thanks for your content. Thank you. Thank you. I appreciate you. Hello, my friend. Tell your wonderful girl to get you a standing desk so you can multitask. Oh, that's one of the best comments I've ever read in my life. I actually want one too, which is wild, but I do catch your drift. I do. I told her, I'm like, girl, some people just don't like me. So I'm like, if some people are mean, you got to be prepared for that. If you put yourself out there. She's like, oh, that's fine. I'm like, they might be like real mean to you. I'm like, I've heard some fucked up things in the comment section, but she was real cool. She's a champ. You guys are cool for showing positivity. For sure. And I had to do the clickbait with the, with the thumbnail and all, I had to do it. But yeah, those mortgage rates, which kind of makes me concerned for companies like Tesla. Not even, but add this on top of it, that they are like reducing their employees by by such a large percentage. Mortgage rates being at 6%, auto loan rates, those are going much higher than that. You're probably looking at, depending on how you finance it, but even with good credit, if a mortgage rate's 6%, I would imagine any auto loan's going to be, 8, 9, 10% at the minimum. So, some of those more expensive vehicles, or even just vehicles in general, might start to see some of that demand destruction. That's a word you guys are going to hear a lot coming end of July, once you start to get a lot of the big high-flying earnings, like your Teslas, Nvidias, Apples, Microsofts. You're going to start to hear demand destruction, and, when that starts, it's a very slippery slope. When people stop buying things, they pretty much stop buying things, and when cost of capital becomes too expensive, that's why you see recessions, and that's what the Fed is trying to do. So I would just be a little bit, I'm not saying these are bad companies, I'm not saying to sell out, do what you want to do, but Lucids, Polestars, Teslas, they're really going to have to put up some great numbers and show that they are not seeing that demand destruction to keep their valuations that are so high. That's what I'm going to say. Like Tesla, there's a reason they're at a 200 PE ratio. It's not because the business is invincible. It's because they have seen 50-60% growth year over year with billions of dollars of revenue. If that kind of starts to take a slide, just, be careful. That's all I'm saying. Don't risk more than you can't afford to lose in a 5 to 10 year time period. If you invest in a lot of these higher multiple stocks, I think it's going to be a good bet. Don't get me wrong, but don't have a timeline set on it. Invest for 5 or 10 years at that point, not 1 or 2 years. I think that's a real good golden nugget, especially right now. God bless, broski. What's the forecast for tomorrow? Well, there's really 2 ways this thing plays out in my personal opinion. Well, obviously 3 ways. You could get a big down day, big up day, or a flat day. What's going to cause a big down day is going to be the same thing that caused this 12% drop just as of recently in the S&P. This right here, right? CPI came out. And you got a really, really bad market reaction. 1% down move, 2.3% down move, 3% down move, almost 4% down move, 1/3%, and then ultimately that last 3.31% down move. This was because of CPI. CPI came in at the highest read that we have seen at 8.6% when we were not expecting that. Everyone thought CPI was going to peak out in March. That did not happen. Now, same thing with PCE. And if we go ahead and look at this is what we have seen over the last, months, right? So January 2022, 6.1%, and then we went to 6.4%. And then in March, we peaked out at 6.6%. April went down to 6.3%. If we come in higher than 6.6%. I'm not a fortune teller. I don't know if it's going to happen with 100% certainty. But if we come in higher than 6.6%, then the markets freak out and you will guaranteed see a 2 to 3% down day, in my personal opinion. It's going to play out just like CPI. And then, if it comes in at, expectations, which let me go back and see exactly. Expectations look like 6.3%. If it comes in on expectations, probably going to be a slight, up or down day. I don't think it's going to be a big deal. If it comes in substantially under, let's say it comes in at 5.5%, might be very bullish, but the markets might not like either personal income or personal spending because there's something that is happening in the market. So let me just lay a lot on you guys right now. There's this battle going on between a recession and inflation, right? So get the mix, and that's not good. But what happens to inflation during recessions is inflation plummets. The price of oil plummets. The price of everything plummets because you're not seeing that kind of demand. Usually it's because of the Fed pushing us into a recession. Typically what causes a lot of recessions, right? So you're getting this back and forth tug of war. And the best way to actually monitor, call it which side is winning, is the US 10-year break evens right here on CNBC. So the higher this rate is, the more concerned markets are about inflation, because if inflation is going to be consistent, 3 to 10% per year, why would you take a 3% year yield for 10 years? You wouldn't do that. So that's why this yield peaked out at 3.48% after the last CPI report. And then what happened? Well, the market started to freak out about a recession. So what do investors do when they expect massive deflation due to a recession? Is this 3% yield looks a lot better. So believe it or not, if we go into a recession, which shouldn't be too hard to, understand, I guess, interest rates plummet because obviously deflation, usually the Fed doesn't raise rates as aggressively, or they most of the 95% of the time will cut rates. So the cost of capital will become cheaper. Now, if we just have high inflation and no recession, that's kind of your worst case scenario right now. That's not good. Or potentially just a bad recession and high inflation. That's going to be a worst case scenario as well. But believe it or not, a slight recession right now might be decent for capital markets just to bring mortgage rates down, get some demand coming back out there. As long as unemployment stays healthy, should be decent. But that's the thing you guys really want to monitor right now, because there's a push and pull between inflation and recession that is going on. Some days, it's inflation that wins out, and that makes the cost of capital more expensive. Investors sell off bonds, thus stocks sell off, right? Kind of the same thing for, odds of a recession, but the cost of capital is the thing people are, most concerned with right now. That demand destruction, that's something you will keep hearing as time goes, and that's kind of why we peaked out on the bonds June 14th. And if we look at the stock market, we peaked out or almost bottomed in the stock market, pretty close to a bottom June 14th. And then what has happened? Well, you have retraced to the upside. What was that? About 5% still from the bottom, as the 10-year treasury yield has come down, as the cost of capital has become less expensive. This is all due to fears of a recession. Bottom line, if people expect higher and higher inflation, the bond yields will continue to go up. If we have really bad PCE data tomorrow, which is the main metric the Fed likes to pay attention to, well, you're going to see the market sell off in a big way. You're going to see bond yields jump in a big way, like we did after the last CPI report. So keep that in mind. That is a golden nugget, and that can really help you to gauge kind of what you're doing in the markets, what to expect in the near-term future. And that's why tomorrow is going to be so important. What if we get like 6%? I don't expect a big move at 6%. I think you really need to see some impressive PCE numbers, like a 5.5%, read to get a big green day, like a 2 to 3% green day. Could be wrong. Best case scenario, in my personal opinion, personal spending comes in really good. Personal spending, personal income, month over month come in really good. And then PCE comes down in a big way. That's where you get the big up day, because, personal spending good, personal income good. That's recession, right? That's good. Probably not going into a recession as quickly. And then PCE coming down, obviously, that is good for inflation pressure. So that's like the best case scenario. But 6%, I would imagine it doesn't have a huge effect on the markets. Unemployment goes up, inflation comes down. Yeah, that's really, neck and neck with the whole recession thing. Pretty interesting though, what we're seeing right now. It looks like we're heading into recession faster than not, and unemployment is not coming down, really at all yet. Which I think we will start to see unemployment, going up a lot more. But says, hello, my love, listening while driving tonight. Okay, truck driver. I'm just playing. She ain't a truck driver. She's actually a server. I told her, come hop on YouTube. People will love you. But I don't know. Thank you for the intro. People love it, and we clickbaited them. Yeah, she does. She's real cool. It's great. Never underestimate corporate short-term thinking and executive greed. Job losses will be devastating to many families. We've all seen this movie. Yeah, dude. Oh, no. Forget any of this, okay? Dude, the most tragic thing I seen today, and this is going to sound stupid, but it definitely hit me hard. Okay? McDonald's, right? It kind of makes me want to buy some McDonald's stock, to be honest. McDonald's hot fudge sundaes. Dude, when I was a kid, 5 to 10 years ago, getting older now, but, 5 to 10 years ago, well, really like 10 years ago, 5 years ago, I was a grown-ass adult. 10 years ago, let's call it that. Dude, I used to go get hot fudge sundaes for $1.06. Guess what these things are going for now? And they're smaller now. $2.40. I said, what the hell happened? I ain't got a hot fudge sundae in a long time, but this is over double. McDonald's is killing it, man. Half the time the ice cream machine don't work anyways. I'm like, this is crazy, man. Inflation. Nah, I just say inflation just randomly. Fucking inflation. It's crazy. It was tragic, honestly. I was like, I think I said it like 5 times to Alex. I'm like, I'm blown away right now. Like, what is going on? Dollar hot fudge I'm telling you. $1. They're $2.40. I can't imagine like Cali. Probably like $5. Like, dude. Wild. Like, just wow. Yeah, like 04, yeah. Yeah. Dude, that inflation is crazy. They said, nope. And Alex pointed out, they don't even give you nuts anymore. Of course, she would know that, but they just don't give you nuts anymore. What happened with your theory? I've had a lot of theories, man. I'm not exactly sure. Salute to Tyler. Salute to you, brother. So, manager, actually, your boss. Okay, we the boss in this relationship, okay? I'm the boss. I'm gonna get her on some YouTube videos. She said, well, I don't know anything. I said, half of these people making videos don't know anything. Write a script like they do. What happened with your theory? Yeah. The whole MOAS end of summer, kind of theory. High minimum wage equals high inflation. Man, Michigan's minimum wage is like $9.45. I guess it has went up like $2 roughly since like, 08, 07-ish. But I don't know. It's crazy, man. I was low key kind of heartbroken. Like, wow. I used to get them all the time too, though. So it's like real personal. Cheese Chaser, like the smash button. Tap, tickle, touch, or smash the smash button, baby. Oh yeah, cheers. I opened a beer before this, and I don't even think I took a drink the whole time. So salute. Hot buck Sunday with nuts. Can't beat it. You really can't. You really can't, for real. What happened with your theory when markets and the share to AMC will rise? I don't hear you saying that no more. It's that was never. That's like the long story short kind of theory. But if the theory is correct, which I was saying, was not that if when the markets go down, AMC is just gonna rip to the upside. That wasn't the full spectrum of the theory. The actual theory it is and still is. I think it's going to be the case. But when you see markets go down, you have less collateral and by you I mean hedge funds, and just look at like all of our portfolios. Unless you've been just trading this market, if you've been long in this market, you're probably closer to a margin call if you still have margin debt rather than not, right? I think that's safe to say. Well, on a large degree, same thing with hedge funds. Now, there's a couple ways to look at it. When cost of capital goes up and you have less collateral in your portfolios, less cash, potentially to service margin calls or to stay in business. The average hedge fund only is in business 3 years, so it's got a pretty high turnover rate. Well, if you go bankrupt, you got to liquidate your positions. You got to give those shares back. That's one way to look at it. But if the markets are down like they are right now and AMC gets a big catalyst, that's where the stock can run a lot. If you start to see cost to borrow rates going up like they are, and you see just a reason to buy the stock, a reason for some degree of FOMO to come into the stock, you could see quicker margin calls. So it's not like June of 2021, stocks were going to the moon, right? You could get a loan for 2%. Damn, Citadel was bailing out Melvin Capital. That's not going to happen this time around. Hedge funds are not going to bail other people out. Banks are not going to step in and bail out a multi-billion-dollar hedge fund that made a bad bet. It's not going to happen. You are going to fall victim to capital markets because Wall Street is the most ruthless place in the world. Non-violent, ruthless place in the world. And it probably does get violent on Wall Street. But, yeah, that's basically the full scope of the theory. There's more nuances you could point out, you know, depending on what you see fit. But that's pretty much the summarized version of that theory. And I still think it's in play, like very much so in play. And honestly, it's better than I even expected. I did not expect mortgage rates to go from 3.25% last March to 6.4% almost a year later. Didn't expect that to happen. You know, credit lines, all that's more expensive. Like cost of borrow rates, all of anything where you borrow something is more expensive now. And at the same time, the NASDAQ is down almost 30%. So either way you want to put it, hedge funds have less capital to service margin calls. They have less collateral to put up for margin calls. All those rule changes along the way really are helping out in a big way, in my personal opinion, or at least they will. All the haircuts that we've seen, all of that, it's going to be a bigger deal than not once we get a catalyst. We need to see a catalyst, though. That's the thing. Without a catalyst, then, you know, people are not just running out and buying a stock just because the markets are dropping, especially not AMC if they're not going to buy an Apple or a Google or an Amazon. So, yeah, that's basically that. And I am going to go ahead and wrap this up, guys. My light is doing some weird things here tonight. It just got really dark. So thank you guys for tuning in. Appreciate all of you beautiful souls. Thank you guys for showing love to Alex. If you guys have not seen that video, she killed it. Go ahead, check it out. I put her in the thumbnail to clickbait it a little bit for you guys. But massive warning, watch this before tomorrow. Her pretty little beautiful face is in the thumbnail, so definitely go ahead and check that out. Basically give you guys the whole summary, what to expect for tomorrow. You know, how it could be a bad day, how it could potentially be a really good day in the market. So that is it. Thank you guys. If you want to come trade with me live in real time, link down below in the description of this live stream, and get yourself those free stocks. If Alex did it, any of you guys can. So thank you guys.